was entitled Moving Ahead because to me, these are some of the most innovative and forward-thinking people, notice I didn't say women, people in impact investing, and they have been for a very long time. And so I wanted to just have really a discussion about where we've come, where we've come so far, and what are the major hurdles to moving ahead, and how we as an investor community can sort of coalesce behind what these hurdles are. And I think this will be an interesting discussion because both Christina, Deborah, and Tracy actually all work across different sectors with different investment types and different product types, but all have really contributed to this space. And I'll have them tell you a little about that, even though they're going to hate that part of it, talking about themselves and how innovative and influential they've been in this space, but I'm going to make them do it anyway. So just quickly, Christina Levenfeld is managing partner at Tideline, and she also created the social finance business at JP Morgan. She actually created impact investing at JP Morgan, just as a note. So, Deborah Schwartz is managing director of MacArthur Foundation. You probably know what MacArthur has done and what Deborah has led, but they've dedicated $500 million to impact. And Tracy Palangin is the CEO and co-founder of Social Finance. She has also been vice chair of the G8 Task Force and the newly created U.S. Impact Investing Alliance. So just quickly, we don't need to go through your all backgrounds, but can you sort of talk about just the spaces that you've worked in and where your firms or you yourself, though I know you're going to be reticent to say that, have pushed the impact space forward a bit, just to give people some context for the conversation.
Sure. Thank you, Anna. That was really, coming from another leader in this field, that was very, very generous and undeserved on my part. But I think, I left JP Morgan a few years ago, having been there for 16 years of my career, the last 5 years of which were running the social finance group as a unit of the investment bank, and frankly left in frustration in 2012 for having felt that we'd sort of been an early mover, had an incredible opportunity to help bring clients along in this movement, and seeing kind of the walls of resistance at some level begin to creep up post-financial crisis, and just feeling how challenging it was to provide the kinds of services that I was seeing clients asking for. So that was sort of the seeds of Tideline, and two business partners and I, Kim Wright-Vielich and Ben Thornley, and I created Tideline as a dedicated consulting firm in the impact investment market, really to solve or help contribute to what we saw as a critical gap in non-conflicted but professional advice to clients who need a whole range of custom advisory services and consulting services. I think for us it was really important we be as conflict-free as you potentially can. There's a lot of hype in this market, and a lot of need for really rigorous analysis and clarity, and so not selling product and not gathering assets under management was kind of core to that business model for us.
And we'll get back to that hype later on. Deborah.
Thanks, Anna. I think that at the MacArthur Foundation, because we've been doing this thing called impact investing, not with that name, for 30 years, there's a chance to look back and see sort of at different places along the way where those envelope edges were pushed. I think back to what predates my arrival on the scene. I've been leading impact investing for half of the 30-year time at MacArthur. And I think what predates me is some of the very early experiments in using concessionary finance to do leveraged transactions, to provide credit support, to provide subsidy, to provide patient capital, but not full-on what we would call blended or stacked deals. I think those are something that we really began in full force. One of the first that I worked on was in the early 2000s, working with Fannie Mae, the Methodist Pension Fund, and the city of Chicago. That was also our first guarantee. And then the New York City Housing Acquisition Fund is another blended transaction, but we've actually done about 15 total, public-private, blended, stacked, whatever you want to call them. Another thing that I think we did early on, and we didn't realize it had a name, and you've talked about it here today, is what we would now call enterprise finance. And so we undertook a big initiative working with nonprofit housing organizations and provided them with quasi-equity to allow them to grow their businesses and to pay us back out of their increased development fee income. And it has worked quite successfully. And again, it's now a thing, but we were just doing it because it was solving the problem we were facing. And then I think most recently, the two innovations. One was an experiment with a liquidity facility, and we heard this morning that I guess that's tantamount to working on a burning building or something. I didn't get the exact word.
For OPIC, anyway.
We did one, and we are continuing to experiment around the issue of liquidity, believing that that's an important barrier to address. And then the other is trying to find ways to create on-ramps for investors and solutions for enterprises that match them up more efficiently, and the best expression of that for us is something called Benefit Chicago, which we launched this spring.
Yeah. Amazing.
Well, it's wonderful to follow Christina and Deborah, who are such longtime giants in the industry. So social finance and I are relatively newcomers in this much broader impact investing industry, and our work is very much focused on, is this okay or is this massively echoey?
It's echoey, Benzer.
How about if I hold it? Okay. So the social impact bond, or the Pay for Success, is a relatively newcomer to the broader impact investing landscape. And for better or for worse, I know that there's been a lot of quote unquote hype about this. So the tool has either gotten oscillated between this outsized optimism about its promise and the potential to declarations of failure. And I think 6 years in, this sustained attention on this tool has given us a lot of lessons, especially with 60 projects now launched in 15 countries. It's now a wealth of really exciting examples and structures to learn about how best to refine this tool over time. But what I think is unique about the social impact bond, or the Pay for Success vehicle, as a new impact investing instrument compared to the long history of community development finance and all the other amazing projects that Christina did when she was at JP Morgan, to even some of the earlier conversations today from the agenda, public markets investing, et cetera, is that it's creating an investment opportunity by working at the problems or the challenges facing our most vulnerable populations. So inherent in the social impact bond model is this very targeted focus to responding to the needs of people who are homeless, people who are leaving the prison system, refugees who are in need of language and integration support. It's through serving these very vulnerable population, which traditionally resides in the realm of government, right? This is government's role, that we're driving an opportunity to have an investment proposition, which is using the tool to redirect the way our government spends money to serve these vulnerable populations and to drive greater effectiveness, more results from the government spend. So I think in that sense, the idea that the impact is so inextricably and explicitly and directly connected to human life improvement. It's someone getting a job, going to kindergarten with kindergarten readiness, graduating from high school, not recidivating back into the prison system, that provides the investment return back to the investor. There's something quite elegant about that. And it is kind of our broader sense and our hope that this could, as again, very early stage, only 6 years into this industry, and for all intents and purposes in the United States, only 3 years, because the first project in New York City at Rikers was launched in January of 2014. So it's still very early days, but the hope is to build a financial market to invest in human outcomes, in social outcomes, as we have such a thriving market to invest in our physical infrastructure. So that's the hope. But I also think that, it's exciting. to think about how much momentum the quote-unquote impact investing industry has garnered, while it's already been expressed over the decades by people working really hard in the field. But it's also interesting to think about the nuance that people are beginning to look at the opportunities, across asset classes, across return profiles, risk profile, liquidity. And while all those dimensions, risk, return, and liquidity can be more easily measured with a more objective framework, impact is just tough, right? It's just like grant making. There are just many flavors to it, and I think that from the social finance point of view, our contribution in thinking about impact from the point of view of the individual on the ground is another way of thinking about it.
Let's pick up on a couple of these points that have been made, because I think that the often, and we started out talking about what's the role of public capital versus private capital, but private capital in impact takes a lot of different forms, right? And I think that I know that you all have very, I think, opinionated or opinions, I guess, strong opinions on what different roles different parts of the private investor base can have, from catalytic capital, when you're talking about concessionary capital, market rate capital, and your experience as you're working with these different investor bases, like where do you begin, from obviously from a foundation perspective, but where do you begin to parse out what your role is in expanding the impact space, and what different investors' roles really are in this space? Like, what is actually, like, everyone talks about this ecosystem, but what is that ecosystem, and how does that actually work, right? I'd just be interested in your thought.
Well, that's a giant question.
I know. And that'll be the last question of the
Done and done. I will just say I thought of two other things that were envelope pushing, because I saw Bonnie walk in, and one of the things was that our foundation started making investments in private equity impact funds in 1995, which I would argue is probably as early as it existed, and did a whole bunch of that, about $25 million.
And this is why you're the most popular person at any impact conference.
And the other was environment. I mean, there were environmental investments that MacArthur and some others, but Packard, we were making in the 1990s and things like that. And it's interesting now to see how, I was talking to someone earlier, how something that seemed like a real pie in the sky and turned out ultimately to be unworkable, doing solar in India 15 years ago, that wasn't such a great idea, but then you get to today, and that seems like that might be in reach. And I think that has a little bit to do with the answer to where do these different investors fit and what is our role. But I really appreciated Elizabeth this morning saying that she struggles with this question of what to subsidize and what not to subsidize. And I think we have to be honest, first and foremost, is I can call it catalytic or concessionary or whatever you want, but if at the end of the day, our institution is placing capital in a form that has a lower return for the risk involved, or more risk than the return involved than an ordinary investor, that's a subsidy. And sometimes the subsidy is a little bit more difficult to perceive, and sometimes it's, I'm willing to put the effort in, absorb the costs, deal with a transaction size that's either too small or too big. And those are a form of subsidy as well. And I think there has been some good writing and discussion of the idea of smart subsidy. But what, at the end of the day, we don't know is exactly where that line is. When am I crowding in and catalyzing something that's going to have a multiplier effect, it's going to bring in other capital, it's going to demonstrate an unproven enterprise or business model or financing tool. It's going to grow, and into having really magnificent impact. So when am I making this smart catalytic choice, and when am I actually crowding out and distorting? And I just, I pray that there is an answer somewhere, maybe in the DFI world, somewhere, because it is a decision that it's not just impact investors that are making. Government has been making this decision about providing subsidy for a long, long time. But it is one of the things that I'm the most challenged by, because once we've committed to do it, in a transaction, it's actually not that hard to push the other investors to their limit and to find out where that frontier is. I mean, you find it out through a dance, and you keep taking things away, and you find out the place where those investors are no longer going to play. And that we always try to do to be efficient. But I don't know what that right line is. It's just that there are some investors, like foundations and a few family offices, but I've really not encountered any institutions, that are able to take this catalytic but-for role. And then there's a whole bunch of investors that are super impact focused, but need that more conventional risk-return profile.
Right.
I think my own thinking about the spectrum of investors that fit under this broad tent has really evolved immensely over the last few years. Ironically, I think back when I was at JP Morgan, I was so paranoid about being accused of greenwashing that I took quite a narrow view of the market opportunity, and I sort of did that as a self-protective mechanism in many ways, both internally and to the external world. I did not want it to get sort of dumbed down or greenwashed, but I realized kind of in recent years, whether we like it or not, we're all sitting in a big tent, and there's a really vast spectrum of investors and potential strategies and product opportunities. But you know, as much as we want to put things in a neat box and characterize things singularly, you know, impact investing does this for you, the truth is so much more complicated than that. And I think there's room for all investors, but the infrastructure for this market, the standards, the tools, the frameworks are really catching up to the market itself. So that's a big challenge. I do think catalytic concessionary capital is in very short supply in this market. That's become crystal clear to me over recent years. The work that MacArthur is doing is so critical and so needed. And I think, honestly, more foundations should be doing that kind of work with that type of capital, because there is an ample supply of that out in the broader investor community.
I agree, and I also think that it's exciting to think about also the role of high net worth individuals in this spectrum, right? So if you think about foundation capital to unlock more institutional capital, which often have a fiduciary duty, and despite, you know, the great new executive guidance that Tom Perez out of the Department of Labor did, when was that? The fall, exactly a year ago. Yeah. Last fall, that it is okay and it is prudent to consider non-financial factors such as ESG, that I don't really feel the uptake in the market since that clarification. So I think fiduciaries are often shackled despite the great efforts to unshackle them by the Department of Labor's recent guidance. But high net worth individuals have a very flexible investment mandate, and the idea, and that's why your firm, Anna at US Trust and Merrill Lynch at Bank of America, to really begin to look at more product to unlock family offices and high net worth individuals' participation in this growing field is really exciting. And to quote your survey, and I think it was 60% of your clients, the US Trust survey, wanted to express their values in their investment portfolios. And then if you cut it by gender and by age, you know, the women and the younger folks, that percentage goes way higher. So I think the role of the high net worth individuals and families could be a real boost to the impact investing industry.
So what's so in your years, what's gotten easier, and what are still some of the major hurdles that you see?
I think in the last sort of 5 years, the one thing I would say has gotten easier is I think product availability is much greater. I think I mean, we're seeing more and more products of every stripe, whether it's screened products, tilted products, ESG integration products, private asset classes, more and more second-time, third-time funds. I think what's gotten harder is the sort of matching process. So I think really, again, as the market grows, matching an investor's kind of unique preferences with the characteristics of the product to meet their very, very bespoke impact objectives and portfolio thresholds is a very, very complicated process. I just don't think we have the tools available today to do that efficiently.
Can you talk a little about the impact asset class work that you're doing to try to at least give us a tool?
I'm happy to go back to that.
Yeah.
But impact class, and I wasn't trying to do
No, I mean, that's what you're working on.
But we kind of stumbled on this, and it really informed our thinking through some of the work we've been doing with the Omidyar Network, who engaged us to look at this problem that they're seeing amongst the peers, Omidyar's peers, in really articulating, clients are having trouble themselves articulating precisely what it is they want out of an impact investment, what their impact, the degree of impact specificity they're looking for, the types of impact approaches and methodologies they're looking for. And part of the reason they're struggling to articulate this is because there aren't really tools available. There isn't sort of a catalog that you can go to and place yourselves in. And so we sort of came upon this concept of developing impact classes, which are akin to asset classes in mainstream finance language. And impact classes would be sort of a sorting tool to help people understand, again, the sort of unique impact characteristics of a product as distinct and sort of isolated from the financial return profile of a given product. So it's a concept, and we've written a white paper with the support of the Omidyar Network on it, and are carrying on that work with Bridges. But to our surprise, it resonated immensely with the broader community of fund managers and gatekeepers and impact investors. So it did seem to hit upon, a very specific tool that's lacking.
Yeah. Oh, what's gotten easier?
I was going to swing on the other end and think about the broad public markets, where obviously the impact is a different kind of impact. It's much broader, but I'm very encouraged by just large asset managers and their willingness to go into this world. And I was recently at a conference with some of the largest asset owners, and it was State Street, it was Bill McNabb at Vanguard, and Larry Fink at BlackRock. And the three firms were saying that passive investing, index investing, is now 30% of all AUM in the United States, tripling in the last decade. So by definition, if you are running ETFs, and this is where the world is going toward, you are by definition long-term investors, and the kind of responsibility to vote your proxies a certain way, to really be great advocates as shareholders. I think increasingly these firms are really taking that responsibility very seriously. And I think that is a really good thing. And it could really influence corporates.
What's gotten easier for you?
What's gotten easier?
Yeah.
I think that at some level it's easier to find collaborators because there are so many more high net worth families, foundations, institutions. So that is just true. There just are a lot more folks wanting to do impact investing. But what's remained challenging is, one, being responsive and helpful to all of those people who are coming in new to the field, because we consider that to be part of our responsibility and a privilege, that because of the institution that we're with, that we can be supportive. So I mean that seriously. We cannot keep up, and I think this is true for some of my colleagues from other foundations that have long-standing programs. We can't keep up actually with all the requests, and they're not just from foundations. Hedge funds, other firms. So we're glad to know there are firms out there that we can
Send them Christina's way.
we're glad to know there are conferences and that there are new resources. I think those are things that also have gotten easier to point to. But I also think what hasn't changed is that doing multi-investor impact investing, bringing together coalitions of investors, I don't think, and this is my perspective, but I also suspect if you were to ask someone raising capital, they would also say this, you still have to thread the needle of the issue, the type of impact, the type of financial return and other characteristics, and all those have to be there in alignment. And that just turns out to be really tough. And it gets really hard when you have one of these organizations or transactions that involves something that is substantially new, you know, the pioneer risk. I don't think we're any faster or any better off in terms of trying to knit that together. Maybe at the margins, but not. We need a different system.
Yeah, I was going to say, what would help that, do you think?
So I come from public finance as my original background, and I just keep thinking of what that's like for an issuer to go to an investment bank and be underwritten and have the investment bank buy the issue and take the responsibility of selling it to the investors. And we have a lot of things that are calling themselves investment banks, and they may be doing some of the functions, but they don't have the capital base to actually underwrite deals. And investors don't get the ease of being able to rely on the underwriting. Because even when we syndicate today, we're still mostly talking about situations where you cannot actually legally rely on the due diligence of the syndicator. It's much more like if a group of banks were syndicating. So that maybe echoes again something we heard earlier today, but moving more in a retail direction, but moving to securities that are offered in a way that is much more accessible.
Right.
And I was going to add that the work that MacArthur is leading under Deborah around standardizing term sheets, it's a big deal, right? If you look at our very still artisanal world of social impact bonds, but compare it to, this is a perfect corollary, energy performance contracts, right? This has been around for some time, but the social impact bond is just kind of like the human expression of those energy service performance contracts. Those contracts, every year, it's between $2 and $3 billion of those contracts being underwritten, and each of the deals are between 7 to 15 million. It's a high volume of a lot of these energy service contracts that are being written every year that makes the market just very liquid and very fluent and efficient. So I think a lot of the work that you're spearheading, Deborah, around just getting the field to standardize and work on more templatized approaches and processes is going to be really important.
So I would just temper that. I appreciate it and temper the optimism a tiny bit. The project that you're referring to, I think, is the Impact Terms Project. And so just a couple of things on that, which is that we actually came into funding that after Heron and some of our other colleagues, Blue Haven and Sorensen, were already funding it. But we have picked it up and provided quite a lot of funding since then. I think that it is providing, and if you haven't seen it, it's Impact Terms, I think, project or impactterms.org. I should know the URL. But it has a really wonderful listing of genericized term sheets from real private equity direct deals. And it has a lot of really interesting models like royalty-based financing, alternative exit models to help address another problem we heard Lori and Elizabeth talk about, which is the 10-year limited life fund. But I'm not sure, so it's kind of like a really well-organized recipe book. Mm-hmm. And you can get the layperson language and the legal language, and you can see a case example, and we hope that it can build and grow over time. But I'm not sure that it takes on that full ambition, but it's a good one, which is this idea of, on some fronts, actually standardizing things to the place where there can be a market in them. I just think this whole idea of market making is something that is, again, nascent in lots of quarters, but hasn't really taken hold.
Yeah, I agree. I mean, it picks up on a point that you made, and I don't know if there was a flip side to this comment, but my bias is going to make it one, which is that, you know, there are a lot of products out there, and we heard, you know, discussions at some of the breakout sessions today around, you know, there are products that are pre-institutional, I guess, if you will, and products that are ready for institutional, and that's both around structure, contractual terms, and ease of use, and ease of, you know, scalability and ease of use, and sort of things that institutional investors recognize, right, as a like product to distribute, if you will. So what do you? I mean, yes, there's a lot of product out there, but do you see? Is there a major hurdle around the scalability of that product because of the space that the stage that it's in? Do you see like a path forward on that?
Yeah, I think it depends on what type of product you're talking about. I mean, I agree with Deborah. None of us are in this market because it's easy.
Right.
And I think creating new product, it's still, you know, it's creating really targeted product to solve a social problem. The kind of work that Tracy is doing, the kind of work that Deborah is doing, involves multi-stakeholder arrangements. It involves figuring out, you know, what the different colors of money are that are coming to the table, and the risk-return preferences, and then that doesn't even talk about getting clear on what the pipeline economics are. And I think, you know, those kinds of deals are hard to replicate. I think that is a real challenge, but I do think we're beginning to see, I mean, we've moved beyond demonstration, I think, to I guess, to find a positive thread here. I think, you know, when it comes to some of these very bespoke, highly structured impact vehicles, we've moved beyond proof of concept in many cases. I mean, I remember working on the Global Health Investment Fund for JP Morgan with the Gates Foundation. It was an incredibly complicated fund structure that was then distributed to high net worth clients of the private bank, and you know, nobody had ever seen anything like it, and the marketing of it was very challenging because, you know, the sales force didn't understand it. But that's been done now. I think there's a lot of lessons were learned from that experience. I know a lot of lessons at the firm at JP Morgan were internalized around that, not necessarily. They're not necessarily running with the next deal, but I think the people who worked on that deal, the investors in that deal, have learned a lot from that deal. So, you know, more deals are coming. The fund manager for that deal is getting ready to launch Fund 2. So I think we are beginning to move beyond proof of concept. I think, you know, what is it called, terms.org, impactterms.org. I think in the UK, you know, we've got a repository of different types of blended finance vehicle structures. You know, there are places to go to understand how to put together some of these deals, at least at a high level.
I think also there's a question of whether, I guess for our part of the impact investing space, and again, I'm a little bit fuzzy my own self where my part ends.
That's concerning, just because you're one of the most catalytic people in the space. But that's, I'm just saying. I'm fuzzy. You should not be fuzzy.
But I think our realm of trying to be supportive of enterprises or models that are, for whatever set of reasons, not workable, either at that point in time or maybe even ever not workable for conventional sources of capital. So I don't think the goal is ever to turn that into a widget business, because by definition, it's about the high-touch, customized, flexible approach. So I don't think the looking for something that's going to, you know, blow out with scale is exactly where we're looking. I think a different question is, how can we make it easier for investors to participate in catalytic capital pieces in that part of the stack? How can we grow that pool? Because as you pointed out, Christina, we have to grow that pool. That is the raw material that grows some of the overall scale of the field. And certainly helps ensure targeted impact is possible. I mean, every transaction you do has a catalytic piece, either in subordinated debt or guarantee. So growing that and making that easier to be part of without having everybody have to do that work. So I think, you know, for me, one
Over
of the
and over and
visions
over again, yeah.
is
Yeah.
how can some of us play more of a wholesaler role, if you will, and be doing that heavy lifting and structuring and using our teams and then creating on-ramps for other investors to join with us without necessarily having to do that. So at least we can take some of the friction out of the system and make it easier for the enterprises to access the capital in the kind of pools that they need and not to be patching it, you know, all together.
Which is sort of the kit
You know all
that, the
about
toolkit you put, I mean, that's what you're
It's my
doing
daily
right.
existence. Exactly.
That's what you're doing in the SIB space to actually scale that business. I want to take about a couple of questions from the audience. You can just stand up and ask a question. You don't have to march over if you'd like.
That time of the afternoon.
Yes. Good.
Hi, Alyssa Mercado-Laborde from Global Communities and Vitas Group. I had a question for Deborah just to clarify something. You mentioned your failed experiment in dealing with a liquidity.
Ours actually succeeded so far.
Yours succeeded. Well, I wanted to know.
Yours was a burning house.
Weren't the burning house. Could you talk a little bit more about that? And do you see, how do you see, because liquidity keeps being talked about as a constraint, and I just wanted to understand more what you've done in it.
Thank you for asking us to clarify. There's still plenty of time to run on this investment. No, we're very optimistic and basically found an opportunity where there was a fast-growing social enterprise. It was one that we had helped create and invest in, and it was one of those transactions that had a lot of moving parts and parties. But they were out of the gate and moving along very successfully, but they were in that classic valley of death. They had not yet turned a profit. They could see it on the horizon within the next 12 months. But they also were not to the scale that they would be considered investable by even more conventional impact investors. And I should say this is a social purpose REIT, Real Estate Investment Trust, and it's the only nonprofit sponsored REIT in existence to our knowledge. So they came to us when they could see already that they were burning through all of their equity capital and they would run out of capital and run out of steam, and the whole thing would come to a screeching halt. And so we began to think about how we could help them raise a round of capital while they were still in that growth stage. And I think this is, you know, a very classic situation. The scale is different because of the real estate, and it's in the United States, but so we see it with social entrepreneurs in emerging markets as well, where they're, you know, too big to be little and too little to be big, if you will. What we came up with is this. There were 3 bank investors that were interested in participating and who ultimately did place capital with the REIT in the form of preferred equity. None of them were particularly keen on the equity versus debt. None of them were super keen about the idea that this equity did not have a life on it. So this was not a 10-year fund. These were indefinite life shares, and it says in the term sheet, these shares have no, you know, maturity or life. What tipped them, going to that issue of kind of like nudging just to that place, what tipped things in the balance to work was that we committed something beyond our usual, which had been, we've done credit support, and in this case, what made it a liquidity support is we provided a 25% guarantee total on a $50 million capital raise. No matter what happened, the enterprise could succeed or fail. And the most important was it could succeed and we could still have our guarantee called upon. And the way that it is set up is that they have a series of mandatory redemption rights that kick in starting 5 years from now. And the enterprise is obligated to buy out the shares that total up to cumulatively 25% of the position. And if the enterprise is unable to do that, we are committed to buy new shares. So for us, what could happen is they could get out to year 5, 6, 7, 8, 9, 10, and the enterprise is doing okay, but not able to actually redeem the shares. We end up buying new shares, and then we would be left waiting until the enterprise was in a place where there was a market in its shares, and then we could sell them. So we are banking on the idea that there will be a market in its shares, and everything is continuing to move really well. It issued dividends shortly after the transaction was completed, and they are going to be back in the market looking to raise common without us. And that's sort of another test for us sometimes, is if we can do something that pushes things along, but then step away because we're not needed.
Hi, Joan Tran from Charling Global. And Deborah, you were saying that sometimes you were fuzzy about whether you were crowding in or crowding out. That's an absolute crowding in, so thank you for that. Changing steam on the moving ahead theme, this is to anyone and everyone on the panel. Is there any particular policy or policies that you would like the United States to adopt in the next administration that could really help drive impact investing forward? Thank you.
Well, we were really fortunate to have 2 significant policy recommendations adopted by the Obama administration since the United States NAB, the National Advisory Board, suggested them now 2 years ago. The first one was the one that I mentioned, which is the labor guidance around consideration of non-financial factors. And the second one was out of the IRS around mission-related investment. So before I answer your question, which is an excellent one, I think there is policy changes and then there is adoption and embrace of those policy changes. So if you were to interview the average foundation CIO, I wonder how much of that guidance has really shifted mindsets. That said, I think that what the UK has done around social investment credits, tax relief, is massive. And I don't even know if it's worthy to be even put on the table, but we did kind of look at that 2 years ago and thought that it was not something that could have been accomplished within the Obama administration, but absolutely something that we should push for in the next.
And what our clients are asking for,
exactly.
by the way. Yeah. Mm-hmm.
Lauren Callahan, I'm an executive recruiter with Spencer Stewart. Thanks to each of you for being here today. My question relates to the talent implications within this space. You know, we've done a little bit of search work on the endowment side, you know, recruiting ahead of ESG investing, for example. But we're watching this space with a lot of curiosity. And I'm just curious how each of you are perhaps thinking about building your teams. Also, where do you think there are pockets of opportunity for people who would really like to break into this space going forward?
Great question.
I actually think that is one thing that's gotten easier. And going back to your earlier question, is I think the explosion of talent that is in the space, looking to come in the space, and the fact that there are even search firms like Spencer Stewart there to help us when we have searches, I think that is all a really, really stunning and important difference. You know, I began seeing it because I started years ago speaking at the Net Impact conferences, 15 years ago, and seeing the size of those conferences grow and grow and grow. And now we actually funded a manual on job searching in the impact arena for them. And they have also created a career portal for impact investing that if you are interested in, look at it. It's a great place to refer people if you don't have enough time to do all the informational interviews that you might be asked to do. But we are expanding our team, and I think able to now get more specific and allow people to wear somewhat fewer hats than we maybe did in the past. Some of that's just the growth, so that we have a big enough portfolio that we need a couple of people who are really primarily focused on the back end, on the servicing, and on the assessment, monitoring, risk rating, impact assessment of the existing portfolio. And I think that for a long time, we just assumed everybody would kind of
Pitch in.
pitch in.
I'm not being rude, I'm trying to Anna, you have to excuse me in a couple minutes.
Yeah.
I'm trying to get service to order my Uber. I have to get on an airplane.
Okay, it's
I'm
from the
so
stage.
sorry, I couldn't get the thing to work, so. I know.
Yes, Tracy's commitment is to be home at night in Boston with her daughter. So, yeah, why don't you go ahead and you go ahead.
I was just going to say that talent, it is the most important thing. I'm kind of the entrepreneur on the ground doing this work, and the combination of making change, pushing a field, yet needing to get the support to keep the lights on, it's a really big constellation of skills that our team needs to have. And the talent that we're seeing is incredible, but it's still, you know, you're paying people nonprofit salaries, you're asking for private sector skills, you're asking people to leave really great jobs to do this work. The mission is there, the purpose is there. The question is over time whether the business model could sustain and make sure that that talent is retained. So.
Yeah, I actually have a little bit the opposite. I feel like we don't have the volume of positions to absorb the massive amount of talent that's coming to this market. And I feel like I've been aware of that ever since launching JP Morgan Social Finance effort. When we first put out that very first little press release internally, I had no idea what kind of interest level we were about to tap into, and really incredible desire and passion on the part of young and millennial bankers and even more mature types, like myself at this point, yes, who just want to be a part of this market and actually want to develop their careers in this market. So we don't struggle to find talent at all at Tideline. In fact, we struggle with the opposite. It's sifting through the talent, and you know, we have an extraordinary team, and I agree people are making decisions to trade off compensation, for sure, in the short term for work that they find more gratifying long term. But I think that as a market, we don't yet have the infrastructure necessarily to train up all the young people who want to join this movement. And so I always struggle with young new graduates who want to join this movement because, you know, there is a need to cut your teeth, you know, in kind of, you know, a real disciplined investment shop.
So come work for me, I'll train you, and then you can go work for Tideline.
That there could be something that would be almost of the stature of a Broad Fellowship, but something that would be very purposefully designed so that you would spend time in a conventional financial institution. I think spend time in the public sector potentially, certainly within a nonprofit social enterprise setting, you know, like not just in one shop entity or formal rotation. And I believe there is at least one foundation that is thinking about right now funding fellowships, something like that.
So perfect way to, I think, end this panel. Thank you all so much.